Good morning, grade 12. So we are starting chapter 7 today. I am only sending you the first lesson, which is the key concepts as introduction into this chapter. And then we will continue with this chapter after the long weekend. Okay, remember it is a long weekend, so I'm not seeing you on Monday. Right, chapter 7. Remember chapter 6, we looked at investment securities. In this chapter, we're going to look at investment insurance. Okay, so specifically, we're going to look at different types of insurances, compulsory insurance, non-compulsory insurance. We're going to look at certain insurance concepts. And this is also a very interesting, applicable chapter. Right, now obviously businesses will operate in a dynamic and risky environment. Obviously every business faces certain risks, all right? Every business has the risk of theft. They have the risk that their factory is going to burn down. They have the risk that customers are going to slip and fall when they're at the shop. They have the risk that their trucks is going to crash and their stock is going to be damaged. Okay, there's lots of risks that businesses are exposed to, especially in a country like ours where the crime rate is so high. Now, when we look at insurance, the whole idea behind insurance is that we are going to indemnify businesses against certain types of risks. So basically, the insurance company takes over the risk in return for the payment of a premium. Okay, so the risk no longer is the business's risk. The insurance, in return for a certain amount of money, will take over that risk and they will transfer the risk onto them. Right. Now, obviously, business owners must have a clear understanding of the financial impact of accidents and disasters on their business operations so that they can make provision for that in advance. We cannot just close our eyes and say, it's never going to happen to me. Okay, as a business owner, they must realize that at any given point in time, the truck can be in an accident. A customer can slip and fall at our workplace. Employees can slip and fall at our workplace. Right. So obviously, they cannot just ignore it and think it is never going to happen. They have to realize that it is reality and it is, maybe it never happens. We don't know. That's the thing with insurance. It's not something that is definitely going to happen, but it might happen. And if it does happen, it will have financial implications for the business. If your truck does crash and you lose your stock, you are going to have to replace that stock. It is money that you paid for that stock. That money is going to be lost. All right, so it does have a financial implication for the business. So it's important that they make provision for that in advance in case these things happen. So insurance is very beneficial to businesses and individuals because it provides financial relief when these unforeseen things happen. So when the truck does get into the accident and you do lose your stock, you have insurance, your insurance company will pay out the money that you are insured for, and then you have the money to replace that stock. You have made provision for this. So insurance is very, very important to have. Right, it helps us to keep the business sustainable. Sometimes if these losses are so very, very big that we absolutely cannot recover from those losses, it can cause the business to actually close down. So insurance is very, very important to make sure that the businesses can continue to exist in the case of an accident. There was an ad on TV at some stage where the girl spoke about her father buying the car and he started operating a taxi business. And then, he never was insured because he's a careful driver. And then somebody else borrowed his car and he got into an accident and he lost his entire business. That is the risk that is there if you do not have insurance. Okay, so insurance is very, very important. If we just look at the different definitions, what is insurance? Insurance is literally a contract between a person or business that requires insurance cover and the insurance company that is willing to transfer the risk upon themselves in return for that premium. All right, so it's a contract, it's an agreement between an insured person, the person that wants insurance, and the business, the insurance company that provides that insurance. An insurance contract is the agreement whereby the insurer undertakes to indemnify the insured in the event of a specified loss in exchange for a premium. Okay, the contract, remember, it's part of contract law. It is an agreement. Both the insurer and the insured has to sign. There's certain requirements, but the insurer and the insured reaches an agreement. In the case of X, Y, and Z, if this happens, this is how much we are going to be paying out. This is the premium that you have to pay. All right, so in this contract, it will specify exactly what eventualities will cause the insurance policy to pay out. Now, what needs to happen before this insurance will pay out, and what does the insured have to do in terms of the premium, the premium that he has to pay for having this insurance. Right, when we refer to the insurer, this is the insurance company that will take over the specified risks. Right, there's obviously different insurance companies. We all know Outsurance, Old Mutual provides insurance. There's a whole bunch of companies that provides different kinds of insurance, but it is a financial institution. Insurance companies is also financial institutions, so they're also regulated by laws applying to financial companies. Okay, but they are the company, the financial institution that is willing to provide insurance cover to other people, and then they take the risks upon themselves. The insured would be the individual or the person that takes out the insurance coverage. Okay, so if the business needs to take out insurance to protect them against workplace accidents, or they take out insurance to protect the loss of assets through theft, that the business that is taking out the insurance, that will be the insured. Right, to indemnify means to compensate or protect or repay the insured in the event of a loss or damage. All right, so if we say that the insurance company will indemnify the insured for losses, it means that if a specified event does occur and the business does lose money, in the case of the truck crashing, for example, then the insurance company will compensate. They will pay out. They will give the business the money that that stock was insured for. All right. So the insured person, in other words, will get the money to replace that which was damaged. Okay, when we talk about the insured value, that is the amount of money that is agreed to by the insured and the insurer to insure the assets or the life of a person when the contract is signed. All right, now different insurance contracts works differently, and it's always important to make sure what exactly your contract says. If your assets is insured at book value or replacement value, that is obviously going to determine the payout that you will receive. So this insured value is specified in the contract that should your truck be in an accident, we are going to insure this truck for 500,000 Rand. Okay, so the amount of money that you insure your assets for, that is what we refer to as the insured value. Okay, that's the amount of money that will be paid out if that specified event, the accident, happens. Right, book value, accounting people, this is easy for you. The book value will be the purchasing price of an asset, but less depreciation. All right, so book value means the value of that asset right now, not the replacement value. Okay, remember when you buy a truck, for example, when you buy the truck, it might be worth R1 million. But every single year, the value of this truck will get less through depreciation, wear and tear. We are using it. You're not going to, when you sell that truck after 5 years, you're not still going to get R1 million. You might get 500,000 Rand. Okay, the book value is what you paid for the asset originally minus the depreciation to make provision for the fact that there was wear and tear and that truck is no longer new. Okay, so should you sell that truck now, what would be the value of the truck now, not what you paid for it originally? All right, obviously if you insure for book value, when the insurance company pays out, they're going to give you the money that truck is worth now. But should you be wanting to buy a new truck, that is obviously not going to be enough, because it's not the buying price, the selling price of that truck. All right, it's the purchasing price of a new asset minus every depreciation that has been taken off every single year that this truck has been in use. The book value will always be less than the replacement value. Right, when we refer to risk, we say that the risk is transferred from the insured, the company, to the insurance company, the insurer. That when we refer to risk, we are referring to the possibility of losses. The possibility that something is going to go wrong. And remember, with insurance, it doesn't mean that these things are definitely going to happen. Okay? Sometimes it happens, sometimes it doesn't. Sometimes you're lucky and you live in South Africa and your trucks drive around on the roads and they never ever get into an accident and nobody ever breaks into your factory. But the risk refers to it might happen. Things that might or might not happen. the possibility of those things happening. All right. And obviously when they determine your premium, they assess your risk. If your risk is higher, so the possibility of this loss happening is big, your premium is also going to be higher. All right. That premium of yours depends on the risk. So if your business is situated in a high crime area, automatically your risk is higher because the possibility is bigger that something is actually going to happen. Right, when we refer to the premium is the payment made by the insured, by the company, by the business to be covered in the event of losses or damages. So when you ask the insurance company to come and assess your risk, as I said, they're going to determine your risk and they're going to say, right, if there's these and these things happen, if there's theft, if there's an accident, if there's whatever, we are going to pay out for your damages, but in return for us as the insurance company to take over your risk, you have to pay us a monthly or a yearly premium. All right. And as I said, this premium, the amount of money that we pay to the insurance company on a monthly or a yearly basis, that money we have to pay them so that obviously that's where the money is going to come from if they need to pay out for any damages. All right. We have to pay them the premium because they are taking the risk, our risk away from us, and they are willing to carry our risk. We are paying them for the risk that they are taking. When we refer to life insurance is long-term insurance. You're going to see in the next lesson we will distinguish between long-term and short-term insurance. But life insurance is long-term insurance. It is taken out on the life of a human being and it covers you for the loss of your life. Right, now when you take out life insurance, as I said, it's long-term insurance. You are basically insuring the life of a person. So if that person, if I have life insurance and I should die, then my life insurance policy will pay out a predetermined amount so that my beneficiaries, my dependents, will receive this money when I die. Okay, so it protects for the loss of life. Now, normally, we have the short-term insurance and the long-term insurance, right? With long-term insurance, normally it is based on an event that will definitely happen. Okay, with short-term insurance, your car might get stolen, it might never get stolen, it might or might not happen. But with life insurance, when you are insuring the life of a person, everybody is going to die. We just don't know when. It is something that is definitely going to happen. We are just not knowing exactly when. Long-term insurance is based on a fact. It is going to happen at some stage in the future. Public liability is the type of insurance that a business can take out to cover them for damage that is caused by business operations to the public. Should you, for example, go to Pick n Pay and their cleaners have washed the floor and you slip and fall on that floor and you break your back, you have a case. You have a case against Pick n Pay. They have to pay you damages because you got injured while you were shopping in their shop. All right. So businesses, obviously, there's a huge risk. It's not such a big thing in our country. In America, they sue for anything, right? So people sue very easily. But obviously, if your business, your products, your business premises, somebody in your business is causing damage to members of the public, to your clients, to your suppliers, to whoever comes onto your property, and they do get injured or they die, then you need this public liability insurance to pay out if you get sued for that. Right, insurable interest is one of the very important principles of insurance. Your insurable interest is expressed in financial terms. Basically, it is the interest that you as the insured person, as the business, stand to lose if there are losses or damages. Now, you can only insure something. You can only take out insurance if you have an insurable interest. So if that article or that person gets damaged and you are going to suffer a financial loss, then you can take out insurance on that article or on that person. Okay, so it's expressed in terms of financial terms. Now, how much in financial terms, in terms of rands and cents, how much do you stand to lose if that truck crashes or if this person dies? All right, so it's what you stand to lose, but it must be expressed in terms of rands and cents. Now, we can't bring emotion in here. Okay, we are now going to just look at the last couple of slides will be examples of compulsory insurance. Okay, the first one is the Unemployment Insurance Fund, or UIF. This fund will provide benefits to workers who have been working and contributing to the fund and are now unemployed for reasons such as retrenchment. We have spoken about UIF before, earlier in this year, so you should know all the facts about the UIF, but we will look at it in detail, obviously, in the last lesson of this chapter. All right, but if you are a worker that has been contributing to UIF and you become unemployed for whatever reason, then you are entitled to put in a claim with the UIF, and they will pay you a little bit of money until such a time that you can find a new job. Just remember, the UIF does not cover you if you resign. Now, if you voluntarily leave your job, you are not covered by the UIF. Now, it's when you lose your job, like retrenchment, like being fired, dismissed for whatever reason, but not for voluntary kind of resigning. Right, the Road Accident Fund, RAF, or the new name, the new terminology for it, the Road Accident Benefit Scheme, or the RABS. We have never done this before, but this fund pays compensation to a person that was disabled or injured or killed in a road accident. Right, so if you as a person gets injured on the road, okay, we don't have to prove liability, and it doesn't matter whose fault it was. If you were in your car driving on the road and somebody else drives into you, then you have a claim against the Road Accident Fund. Okay, if you are disabled or injured, or if you die, obviously the claim will come from your dependents. If I, as an individual, are killed on the roads, my dependents will put in a claim against the Road Accident Fund. Right, COIDA we've done ad nauseum in chapter 1. Okay, so this is old news. Okay, remember the fund, the compensation fund, will compensate workers financially for any disability or injury that can arise as a result of accidents that was taking place at the workplace. Remember, when you get injured at your workplace while you are performing your duties and you are injured, it causes disability, it causes death, then obviously the compensation fund will compensate you for that, you or your dependents in the case when you die. All three of these compulsory insurances we are going to look at in detail in the last lesson for this chapter.